Hi everyone, Keith Wilson here, spreading a wealth of information. So today I want to talk about receiving an inheritance, and more specifically, let's narrow it down, inheriting a non-retirement investment account. So let's say your mom or your dad, maybe a grandparent or other family member, they passed away and you received an inheritance from them. That investment account that you inherit, it could have stocks or mutual funds in it. So over the years, clients have asked me, how is that going to be taxed to them? So some people have heard of inheritance tax and they assume they have to pay tax on the full amount that they inherit. Well, inheritance tax, or really it's called estate tax. That's a tax on estates worth more than $11.7 million. So most likely that's not going to apply in everybody's situation. So here is how it works. The value of the investment account you inherit will have what is called a step up in basis. All right, step up in basis. What does that mean? Well, first of all, we got to define what is called cost basis. Cost basis is simply, it's what the original value of the purchase price of that investment was. For example, let's say you inherited an investment account from your mother, and it's worth $100,000 on the day she passed. But years ago, let's say she invested $20,000 into that account. That was her cost basis. And let's also assume that throughout the years, she never sold any of it. She just let it sit, and it's just growing and growing and growing. So at this point, she would have an $80,000 gain before she passed. And if she sold it before she passed away, she would pay what is called capital gains tax on that gain. But unfortunately, she passed away, and now this account is yours. So do you now have to pay that capital gains tax on the $80,000 gain? And the answer is no. This is where that step up in basis comes into play. Under current tax law, the cost basis is now stepped up to the value at the date of the death. In this example, $100,000 that you inherited. So if you, as the new owner, sold it when it was worth $100,000, then theoretically there would be no gain and no capital gains tax to you. But what if you just let that account sit there? Hopefully it's going to keep growing, and later on it's worth, let's say, $110,000. Then you sell it. Well, your gain is now $10,000. You would pay a capital gains tax on $10,000. The capital gains tax rate, what is it? It's currently either 0, 15, or 20%, depends on your tax bracket. But for most people, it's going to fall under the 15% capital gains tax rate, which is really a lot lower than the ordinary income tax rate. Let's look at another example. Let's say, though, once you receive this account in your name, what if it drops in value? Remember, what is your cost basis when you inherit? In this example, $100,000. And this cost basis that we use, we calculate any gain or loss to you. But so this $100,000 that you inherited, all of a sudden it's now worth $90,000. If you sold it then, you would actually lose money, right? Realize a loss of $10,000, and you can write that off on your taxes up to $3,000 per year. So in the first year, you have a write-off of $3,000 loss, and then the remaining years, $7,000 is going to be carried over in the future years. So it's really important to note that inherited investment accounts will be treated as a long-term capital gains regardless of how long you hold it. So there are no short-term losses here. Remember, we've been talking about non-retirement accounts that are inherited. Retirement accounts like 401ks, IRAs, and other retirement accounts, those are taxed way differently. So be sure to check with your tax professional before making any changes in the investment account you inherited, because everybody's situation is different. Hey, if you would like to see more videos like this discussing personal finance, be sure to hit that subscribe button below. I would really appreciate it. And remember to be wise with your money.